Hello, you're welcome to today's section where we're talking about penny stock. Now, no time for all of those plenty jargons. We're going straight into business. Now, what exactly are penny stocks? Penny stocks are shares of small companies trading at a low price, usually under $5 per share. They are like the cheap seat of the stock market. They are very low in price. They can skyrocket or dump overnight. Now, for the US economy and the US market, they usually trade for under $5 per shares and sometimes just a few cents. Now, you see, penny stock are attractive for several reasons. One of them is they offer asymmetric upside returns. For example, a penny stock of $2, before you know, in less than 30 days or in less than 10 days, a pump. So penny stock are like your pump and dump in other asset class. As a matter of fact, crypto pump and dump, meme coins and all of that, they lent it from the stock market. So 100% gain, 200% gain, 400% gains are possible. I have a penny stock in my watch list that has done over 957% just within 2 months. You see? Now, so the second reason why they are attractive is they are undervalued and they most of the times they are underfollowed. Now, for the third reason why they are attractive is they can reflect a turnaround situations, undiscovered growth, and niche innovation. So you see, this is why a number of people find penny stock attractive. As a matter of fact, there are some investors in the stock market who do not invest in other stock based on their market cap. They focus their attention on just penny stock, on just penny stock. So we call those kind of investors penny stock traders. Now, what exactly are the characteristics of this penny stock? Number one, they have a low share price, usually under $5 in the US market, and in some extreme cases, $1. Now, in the UK market, they are usually below €1. Then they have a market cap of less than 300 million market cap. All right. Then the second characteristic is they have a small market cap. They have a small market cap. The market value is usually under $300 million below because sometimes they are young markets or young companies, I beg your pardon, they are young companies or niche that are evolving in the market. You get. So the third characteristic of a penny stock is high volatility. Now the prices of this stock can double or crash in a day. So quick gains are possible just as loss is also part of it. Now the fifth reason why, the fifth characteristics of a penny stock is low liquidity. Low liquidity. Now because of their market cap, because of the price, and all of this thing works on the premise of demand and supply. So if there's a low liquidity in the market, meaning not many buyers and sellers at any given time, the number of people who want to buy is not commensurate to the number of people who wants to sell. So you might struggle to get in and out without the price even moving. Then the fifth characteristics of a penny stock, and that's why it's colored in red, is speculative. Now, most of these penny stock companies, like I've always mentioned, I said the stock is not an isolated entity. A stock is a business, a real-time business. They have staffs, they have companies, they make profits, they offer services, they sell goods, right? So for these penny stock that are speculative, these are young companies still trying to prove themselves, prove their business model. I've done some videos in the past about certain companies that are primed to move, but however, they are still underground. They're still building, they're still doing the connection, they're still testing. They are actually in the niche, in the earth niche, right? I did a full extensive video on the two stock set to move, and they are both of them are penny stocks. So you see, sometimes they are speculative. Now, so other times, some are in financial debt, company-wise, their books are not that clean, it's not that balanced, and if care is not taken, they may be delisted of the market. So these are some of the characteristics of the penny stock. Now, it's important I take you through this route so you can understand. Like I mentioned earlier, I said there are some investors in the market who like to play with the penny stock. So penny stock is like the Naira bet of stock market. Okay, so there are certain criteria I look out for before buying any of these penny stock. Number one, I look at for business and revenue model. Number two, inside ownership. Number three, financial health. Then number four, sector. Number five, management. Number six, catalyst. Now, so I will be taking a deep dive into all of these criteria. Then we can make an informed decision and apply this principle to several penny stock on our watch list and see how we can filter some that are not profitable and take advantage of the ones that are profitable. So let's go. Now, number one, the business and revenue model as one of the criteria for picking a penny stock. You see, a low share price of any penny stock doesn't matter if the company, hear me clearly, if the company is actually making progress and they are actually in the business of what they say they are doing. So a low share price doesn't matter if the company, their actual business idea is broken into how do they make money. You get? It is important to note that how do they make money? Because if you cannot tell in one sentence how the company make money, there's a likelihood there are a number of things that are shady that you may not be aware of. So talking about their business model, you want to find out what exactly do they do and how do they make their money. This question is very important because when you are doing research to invest in a particular stock or a particular company, this question helps you filter the unserious ones from those that are serious. I hope this is making sense. Okay. So what exactly do they do? So you have to go to the company's website to find out what they do. So you have to go to the company's website to find out what they do. Sometimes you can go to their investors relation under their website. It's called investors relation and download the PDF. You'll be able to see some of the meetings they've had, some of the speech, and in there contains their business model, how they make profits, where does the money come from, how they generate revenue, and all of that. So you see, how do they make money? You'll be surprised that many of the companies do not have a clear route on how they make money. Yes, and they're listed in the stock market. So if the way they earn money is not obvious or it's too complicated, you are reading it, it be like Chinese, you know they understand that. It means that that is a red flag. So investors should be able to explain like they are talking to a 5-year-old child or a 5-year-old baby. When a baby is asking, Daddy, where are you going to? Say, work. Which work? The same way you're able to explain to that baby what you do, at least these companies' annual reports and investors' relation document should be able to convey to you as well what they do. So if a company, let me give one instance. If a company is into solar and you ask them, okay, well, and you're trying to find out what does this company do? You know all of those big languages they use in LinkedIn. So a company tells you, oh, we are leveraging synergies in a dynamic energy using landscape to the person don't dey speak plenty grammar. Calm down, don't dey speak grammar. Wetin you dey do? If you find that deep enough, you realize that they are selling solar. They are selling solar energy or solar panels to homeowners. But you see, they are just using a fizzy to just bamboozle you. So if you cannot figure out their main revenue source, you probably should not buy that stock. So you want to be able to find out their business model, what they do, and how do they make money. Now, under the business model, you also want to be able to confirm, is the market big enough? And you also want to ascertain what their revenue trends. You get? Because a great product is useless if there are not enough customers. If there's no demand for that particular product, it will fizzle out. Is either the industry is shrinking or the company is not getting something right. So penny stock needs room to grow. So if the total market is tiny or it is shrinking, for instance, before Netflix came, there were a number of companies that were serving us as regards entertainment using DVD. Yeah, DVD rentals. Now, we are all aware that that phase has died. Pata, pata. It's not slowing out, it has died. Pata, pata. Most of these Gen Z generations do not even know what a CD looks like. So if a stock is catering for that need, it means that the market, the demand and the supply is not commensurate at all. There's little or no demand for that. The company will literally just phase out. So these companies, these pen companies, they need room to grow. So if the market, the total market cap is tiny, it means that they cannot even expand. You get, they cannot even expand. So you want to be able to check the industry reports and look at whether demand for that particular product or service is increasing or decreasing. And you'll be able to find out through their revenue trend. Are you getting it? You'll be able to find out through their revenue trend. And their revenue trend shows you how much they are making per year, per quarter, year in and year out. If there's no demand, money will not flow in. Money always flows in the direction of demand. So if there's no demand for this particular product or services that this company has, it means it will affect the revenue. I hope this is making sense. For a company like Netflix, they run on subscription model or recurring sales. So for some companies, subscription models work better. For some, recurring sales will work better than a one-off. So when you look at their revenue trend, you want to be able to ascertain if the revenue is growing steadily. So because recurring revenue makes a company more stable and predictable, which in turn reduces risk. So let me still focus on Netflix. I don't know why I like using Netflix. So for Netflix, because of the subscription model, you see there are a number of repeat customers. If you cannot pay January, you pay during March. If you cannot pay during March, there's one beautiful movie that comes up during July, you still pay. So the customers keep paying monthly and year in and year out. So for some companies, maybe furniture, for instance, you realize that there's the demand may not be frequent. So the capital may spike up and come down the way, spike up and come down the way. You get until the next year again. So you want to be able to check the revenue trend and see if it is gradually progressing. So let's look at the next one, insider ownership. Now, what does insider ownership means and represent? It simply means these top management that are in the company, do they put their money where their mouth is? Do they have liver enough? Do they have liver enough to put their hand on the plow and not look back? That's what insider ownership is about. So under insider ownership, we'll look at insider ownership and insider activity. So for insider ownership, like I said, it means the top management, they put their money where their mouth is. So they have a skin in the game. So when insiders like the CEOs, the top executives, the board members, And sometimes some key employees, when they own a meaningful stake in the company, you observe that their personal wealth is tied to the company's success. So they will not want the company to run for because they have a stake there. So if the stock price goes up, they win. Now, if it goes down, they lose. So this synergy makes them more likely to act in the shareholders' best interest. Is this okay? Now, so if, for instance, the CEO owns about 50% of a particular company, you see, and another CEO owns about 0.2%, I want you to judge which of these two take their work serious. And maybe the other CEO that got about 0.2%, he was given on a, how do they call that, a grammar, was given on a platter of gold, free. So which of these two CEOs, I want you to judge, which of these two CEOs will take their work seriously? You know the answer. So for every time there's a low ownership, it is already a red flag. If the people running the business owns very little, it means that they do not believe strongly enough in the long-term potentials. And secondly, it also means that they are just collecting salaries. They're like hirelings, they're not laborers. So instead of them to build the shareholder value, they're just collecting salaries, collecting bonus, collecting commissions. And thirdly, it could also mean that they were brought in as hired staff, as hirelings. And when the going gets tough, they jackpot, they leave. So for the insider activity, what exactly are they doing? Are they buying or are they selling? These insiders that have their skin in the game, are they buying more or they are not fidgeting and they are selling off their assets? In my one-on-one teaching, I'm able to show some of my clients and students how this insider activity is a major key parameters for not just penny stock, a normal stock, growth stock, value stock, dividend stock, not just for penny stock. And I'm able to show them how to track this using certain measures, track what insiders are doing, right? So one of the criteria, remember we're talking about insider ownership. So under this criteria, the insider activity, we want to be able to see consistent insider buying, which is often a bullish signal and a bullish sentiment for us as an investor before we want to put our money in this particular stock. So don't put your money until you have done this due diligence. You have gone through these criteria. So if insiders are putting their money into the stock, it means that they are expecting good things. It means that they're expecting good things ahead of time. So, but if you observe that there's a consistent insider selling, it means that they do not have the interest of shareholders at heart. They do not have the interest of the company at heart, and it smells trouble. So if the selling is large, oh, yeah, what do? Because if some of these top executives decides to sell little, of course it's normal. There's a time to take profit. But when the selling is consistent, it is large in bulk, and it is recurring, problem there. So the key thing to look out for here is large, sudden selling activity. Are you getting this? So this is very important as part of the insider information. Does it make sense? Okay. So for the insider ownership range, we established before and we said that these top management, they should have their skin in the game. So these small cap and penny stock companies can be risky because of several limited informations, and the prices are usually volatile. So if a company has a strong insider activity and insider ownership, it means that they have a strong belief in that particular company. They will go through turbulence, no doubt, but they have a strong belief. It is beliefs that make companies move from zero to hero. It's not just the process of turbulence. It's not just the process of turbulence. So a high insider ownership simplifies that we die here, in quote. So they are in the boat with you, they are in the boat with me, and the boat with every of the investors who are vested in that particular company. So, but a low insider ownership simply means that the problem they don't move. You get? So you want to be able to check, okay, this insider ownership, you want to be able to see the range. So for a penny stock and a small market cap, like I said, they're usually under 300 million market cap. So you want to be able to see that the owners, the top management, the people that matters, they want to be able to have about maybe 20% above, right? So I would give certain range. Beyond the 20% above, if most of them are holding, let's say, above 50%, it means that even though they have their interest, our interest at heart, they also want control, both the good and the bad. You get? Because stock is beyond just capital appreciation and dividend payment. Stock is a means of power play. It's a means of power play. That's the whole teaching on its own. So if the insider ownership range is below 10%, it means it's a red flag. It means that the management do not have any interest or stake in that particular company. They are not fully vested in the company's future. Are you with me? Okay. So let's move on to the next. Financial health. The next criteria is financial health. This is one of the criteria I look at for before investing in a penny stock. I want to be able to look at a company and say, oh, their company's health is okay. Their company's health is good. Their income statement, their balance sheet, their cash flow statement. So you see, even if it's just a penny stock, I still want to be able to check if the company is alive and they are breathing well. Because some of these companies, they are on life support. So imagine you investing your money there. That's a bigger problem. So you want to be able to check their income, their net income, their cash flow. You want to check if they are in debt. How much cash do they have readily available for the next 1 year? How much cash that is under their asset readily available for the next 2, 3, 4, 5 years? And are they in debt? If they are in debt, to what percent? So you want to be able to check if they have enough cash to keep operation without drowning in massive debt. So and there's a ratio for it. It's called the current ratio. Now, when I teach on fundamentals, I will touch more on that. But for now, I will just define what the current ratio is about. A current ratio is more or less like a quick way to measure if a company's short-term financial health, you get, if it's okay. In other words, can this company pay its bills over the next year using their current assets? So with the current ratio, you can be able to tell and say, oh, they are doing well, they are doing well. So the current ratio is more or less like the current assets that the company has. You want to, I'm trying not to say one or two formulas. I just want to, it's very simple. Okay, but for the current ratio, you want to be able to divide the total assets that they have. That is the current assets that they have. You want to divide it by the current liabilities. And when we say current asset, we are talking about the cash, the account, the receivables, the inventory. You see why I say I do not want to, I'm not planning to go deep in this. When I'm teaching on fundamentals, I will do a whole lot of justice to this topic. So when we talk about current asset, we want to talk about cash, inventory, receivables. Like literally anything that you can always convert to cash if casala boss within 12 months. Then for current liabilities, you want to talk about their bills, their short-term loans, their owing salaries, literally anything that the company must pay as a running operation and cost within these 12 months. You get? So if the current ratio is above 1, it means that they have more assets than debt. And personally, just to deviate, I feel that a number of us should apply some of these ratios to our personal finance. Right? Okay. So if the current ratio is below 1, it means it is risky to do business with them. And at the same time, if it is greater than 1, but it is too high, it means that they are holding a lot of cash or they are not using their asset efficiently. So let me give you an instance. Okay. If a company has a current asset of about, let's say, 200 million, and then a current liabilities of $100,000. Okay, let me make it even. The company has a current asset of $200,000 and then a current liabilities of $100,000. What do you think the current ratio will be? I gave you the formula not quite long. So do the math. I'm waiting for you. The current ratio will be what? $200,000, which is the current asset, divided by what? $100,000, which is the current liabilities. What's the answer? Type it, type it, type it. The answer will be 2. So it means that they have twice as many short-term assets as against short-term debt. So that's a comfortable position to be in. Are you with me? Yeah. So can I move on? So while we talk about the financial health, we're talking about the operational cash, we're talking about their debt, we're talking about their revenue. So for revenue, is the sales growing? The money we're generating from our services or the sales of whatever we're selling, is it growing or is it flat? Or is it even declining? These are the 3 states of every revenue. Is it growing? Is it stable? Or is it declining? So you cannot say as a company you make over 1.2 billion last year. The upper year you made over 1.5 billion. And then this year, at the close of this year, you now say you are making 1.1 billion US dollar. It means you are not moving forward because the previous year was 1.5, last year was 1.9 or 1.7, and now you're giving us 1.1. It means that your revenue is doing what? Declining. So that's a red flag because you are not just blindly investing in penny stock. You want to look at their financials. So in looking at their revenue trend, you want to be able to look, okay, this company, is it growing? Their sales, their revenue, is it growing? So a penny stock with a rising sales is at least attracting more customers and investors. And that's a sign because the business is moving forward. So, but if the sales is flat, just there, it means that the company is not really growing. They might be surviving over time, but they are not gaining momentum. Then if they are declining, I told you there are 3 states of a revenue every time: declining, increase, and then stable. So, but if the revenue is declining, that's a warning sign there. It means that they may be losing relevance to competitors. or there is no longer demand as it used to. So you want to be able to compare the revenue from last year against the upper year, against the other year, and then this year. So 2 to 3 years, you want to be able to compare. If you're looking at the quarterly report, you want to be able to compare. You get? Yes. So still on the financial side, you want to be able to check the profit margin. We know that the revenue is moving up, is not declining, is going up. Okay, so profit margin tells you if they're actually making profit, because if the revenue is going up and the expenses is going up at the same time, there'll be little or nothing left for profit. So this profit margin shows how much money the company is keeping after paying cost of making its product or running its services. So if a penny stock is not even profitable yet, and the margin is improving gradually or is healthy, it shows that they could become profitable if the sales grows and there's alignment. So if the revenue of a particular company is over 1 million USD, and then the cost of goods sold or maintaining the cost of revenue is about $800,000, what do you think the profit would be? $200,000. And then the profit margin is what? 20%. So if the margin is low, it means that it is harder to make money unless miracles happen. But if the margin is high, it means that they can make a lot even without those huge one-off sales. So you want to go for companies that the profit margin is high, above 10%. Sometimes you can choose maybe 40%. So for the burn rate, it is what this literally means is how fast a company is spending its cash reserve. That's literally what it is. How fast a company is spending its cash reserve to cover operating costs or operating expenses. For some of us who are developing startups, who are aware with these terminologies. So with this burn rate, you can be able to tell how long they can survive before they will need another extra fund, before they will come back and say, hey, Monaco donate, give us. So because many of these penny stock companies, like I mentioned, are young growing companies, sometimes they rely on cash piled up to survive until they start making enough sales. So if they burn through, the burn rate of those cash is too fast, they will need money. They will need to raise another money. And they do that through different means. They can do that through taking loans. They take on their debt. They can do that through, I've forgotten the terminology, but they can issue shares as well. So if a company has maybe, you can see this from their cash flow. So if a company has cash on hand for about 5 million US dollars, and then their monthly expenses is about 1 million, it simply means that the burn rate is 1 million naira, before I say 1 million naira, $1 million per month. So what that means with a $5 million cash on hand and expenses, monthly expenses of $1 million, it means that they cannot even survive beyond 5 months. Do you understand? They cannot even survive beyond 5 months. Let's move on to the other criteria. Sector. Sector. Now, for sector, a penny stock sector is like, those areas where people live. They say you are like the product of your environment. So if the area is booming, it means that even small kiosks, small shops around that area would feel some of the trickles of that booming economy in that area. Right? So when we talk about the sector, we are focusing on the cyclicality, and then if the sector is boring or exciting. For cyclicality, you see, some industries, they are tied to up and down movement. In the stock market, if you look at certain industries, they call them consumer stables and then consumer cyclical or consumer defensive. You get? It means that these sectors that are stable, they are essential commodities. So some sectors are tied to the ups and the down of the economy. So you see industries like oil, industry servicing, mining, and shipping, those marine sectors, you see that they tend to rise when the demand and the price for these international commodities are high. And after they cool off, they come down. Do you understand? So also for these sectors, when I say exciting or boring sectors, it simply means how the energy level, the momentum level that is flowing with the capital towards or away from a sector. So money would always flow where there's excitement. So if everyone is talking about AI, renewable energy, what's this other one? EV, yes. Guess what? Even these small companies, they will begin to tap from that energy. They will begin to get spotlight. The profit and the money that is flowing into that sector will trickle into some of these small companies. We call it blessed by association. Right? Blessed by association. So they are blessed by association because they are in an exciting sector. Now, under the sector, there's macro trends, consumer habits, world events, disasters, policies. They can either fuel a sector or strangle it. So if government gives subsidy for solar, you would understand that the stock that service that particular industry would go up. Now, if government also places bans or tariffs on imported goods, guess what will happen? Most of the goods that relies on manufacturing, they will take a toll. So, as a criteria, using sector as a criteria, we're looking at for these sub parameters. And then there is peer performance. Some of these big companies may set the tone and then to flow and cascade into some of these small companies and penny stock. So if Tesla is bringing their annual report and you're seeing profit as their report card, some smaller companies that are into that same niche and industry, they will begin to get pulled along by optimism, investor sentiment. So if there's a problem in the airspace, the number of these airlines are attacked. Even airlines that are not tied to those airlines, they will also be attacked. You can see our sector is very important. So if other peers are performing, to cascade to them. If they're not performing, it will also cascade to them. Then the fifth one is management. In penny stock, before we say, let's put our money here, it's going to pump. We want to look at the management system because it is a criteria for us. Who are the team behind this particular business? Are they shop and clean out people, or are they with that here set of people? Because shop and clean out, when shop clean their mat, when there's problem, they leave. But with that here, people say, no, we are ready to make this work. So who are the teams behind the business? Because a great product would be useless if the people in charge cannot process, execute, and follow through to the end. So you want to be able to see their track record. You want to be able to see their reputation. Have they successfully built anything before now? Have they grown companies before now? What is their track record? What is their reputation? Do they have any history of fraud? Do they have any history of pump and dump services? Do they have any history of shady schemes? So you want to be able to do background checks. You can do a background check on them. Type on Google, if you are doing a research on any of these top management staff, when you look at their website, you'll be able to see some of the top management staffs. When you read their annual report, you'll be able to see some of the top management staff. Look at their names. Go to LinkedIn, type their names there, check them, follow them up. Come back to Google, type their full names, type their link, then type news. You write their name plus news. If there's a bad news concerning that person, you'll see it. So this is one of the ways we check. So you want to also check their execution ability. Now, promise and faith that they do, can they turn plans into results or not? Are they transparent? Are they realistic? When they come, are they saying what is not obtainable? Or they are just chanting on hypes. Or they are telling us sweet nothings. What exactly are they doing when they communicate? Those are the factors you want to look at under management. So because if a management has no credibility, the stock that you are intending to invest in, no matter how juicy it is on the chart, it has no future. So the last criteria I look at for before investing in a stock, a penny stock rather, is catalyst driven. What is driving it? Because you see, a penny stock does not just move. It does not just move without any reason. There must be a reason backing it and empowering that pump. So if you want to see any potential spark that could ignite the price, do you know what to do? Look out for certain catalysts. Are they launching new products? Is there any regulatory approval that has been done recently for penny stock in the biotech sector or industry that are producing new drugs, new vaccines, new reprogrammed DNAs, or certain stuff? Is there a regulatory approval for that? If there is, that's good news. So what will drive this penny stock is good news, catalyst driven. Now, apart from the new product launch or regulatory approval, is there any industry news surrounding that stock and the sector? Is there any news that could benefit that particular niche? Are they buying up another company or another company is buying them up? I want to check those acquisitions. You want to be able to check. Do they have any major partnership or any major contract? So because penny stock do not just climb. No, they do not. They're not like other stock that move steadily, slow and steady. No, they're like pump and dumps. So they may sit quiet for a while, just like the 957% stock I told you. It was sitting quietly for a while, unnoticed, undervalued. Then, all of a sudden, we saw the spike. And of course, you cannot jump in. So a catalyst is anything big, good news, an event, announcement that would give a lot of investors good vibes, good sentiment. Their heart could cool. So it gives an investor a reason to what? To suddenly want to pump their money into that particular asset. And when there's buying pressure, price will go up. Are you getting it? If you have any question, please drop it in the comment section. So if you hear that, oh, there's a sudden rise in cocoa price, or there's a sudden rise in copper, or there's a sudden rise in semiconductors, you already know what to do. I hope this is clear. Please, I want you to understand this. So if you're having any question, please drop it in the comment section. So buying a penny stock without any clear upcoming catalyst is like you toasting again in the dark. Even when she answer, you no go see her. So because a catalyst gives you that timing and the reason. Otherwise, if you buy a penny stock with the hope that, oh, it will shoot up, you may just be holding a shit stock. So these are the criteria that I look out for before buying a penny stock. I look at their business and revenue model. I look at their insider ownership. I look at their financial health. I look at the sector. I look at the management. I look at the catalyst. What is driving it? What is driving it? Now, if this video is of immense value to you, please like, share, and subscribe. And until we see again, stay profitable. This is Trader Kessie. Have a good day.